Hello, welcome. Thank you for joining us today. We are broadcasting live from Park City, Utah, where I am, and Jeff is in San Francisco, I believe,
Hi,
uh,
everybody.
in his basement, and Curt is in Dallas. So we're super happy to have Right Side Capital Management back again. We're so delighted that they've come back and presented to the group many times. And so we're super, as I said, super happy to have um, them back. Jeff is presented prior, and this will be the first time for Curt. So welcome, Curt. Um, so just a little housekeeping. We know you're there. We can see that you're there, but if you would like to ask a question, and please post them to the chat and the Q&A as they come to mind. We have a lot of people coming on today. We'll get to as many as possible during the webinar. And then if we miss any, they'll be shared with Jeff and Curt, and they can answer them directly post-webinar. We'll also make sure that you get directly in touch with Jeff and Curt post-webinar if this is interesting to you. Our objective today is to talk about Right Side Capital Management, and they're raising money as usual. And so be mindful that if you're looking to get funded, then that's a different subject and a different conversation. Today's objective is to raise money for Right Side. So with that, thank you all for being here. Please feel free to post your questions to the Q&A in the chat, as I said, and we'll get to as many as possible. So welcome, everybody. Curt, welcome. Take it away.
Thank you, Arthur, and thank you all for joining us today. It's our pleasure. I'm Curt Pabst. I'm a venture partner at Right Side Capital. And our topic today is a little bit of a mouthful. We'll attempt to demystify that and make it a lot easier to grasp. But the basic idea is we're going to take a hard look at venture capital, the ecosystem of venture capital investing. We're going to point to a sector that we've identified as having the best risk-adjusted returns, and that's very early stage VC. And of course, we'll spend a lot of time talking about tax because it turns out that what we do is extremely tax efficient. Before I can start, I'm obligated to share some disclosures with you. I don't intend to read this. I've got a much shorter version to share verbally. So before we get started, so nothing contained herein should be considered or interpreted as investment advice, legal advice, accounting, or tax advice. The information we are providing is not intended for public use, and it is only intended for accredited investors. There's more here for those of you who can read very, very fast. So let's take some time and kind of set the stage for our topic of early stage venture. So I suspect many of you are familiar with venture capital, investing in venture capital efforts. And this is kind of the landscape, right? So venture capitalists invest in new companies. In some cases, it can only be an idea. It might just be an idea. That's kind of on the far left side here. And they'll invest all the way through to what we call late stage VC, growth equity, which you might think of as pre-IPO. It's no surprise that on the far left, when you're investing very early like we do, it tends to be higher risk and higher return. There are lots of things that we do to mitigate that risk, and we're going to talk a lot about that. But just in terms of framing the investment ecosystem, we invest very early where we think we can get the highest risk-adjusted returns. Jeff and his co-founders began the work that culminated in Right Side in 2010, doing a lot of research on what makes successful venture stage companies and venture stage investments. And the thing that their research led them to, and what Right Side has been doing since 2012, is hyper-focusing on the best risk-adjusted returns, which come from investing very early in companies. That's a big challenge because, as you can imagine, investing early is also very risky. If you think about it, you've got companies with new or in some cases unproven business models. In some cases, pre-revenue. Some VCs will invest pre-revenue. And so single company risk early is very high. So without proper diversification, it's a risky bet. We'll talk quite a bit about what we do to mitigate that risk through diversification. It's also not easy to invest in a lot of early stage startups. The round sizes are small. And for the amount of work it takes to make an investment decision, VCs typically like to invest in bigger rounds. So putting this all together in a 3-year process that led up to launching our first fund in 2012, the team decided that the opportunity set exists in investing ahead of the VC herd in capital efficient, and we'll say that often, capital efficient tech companies, and diversify massively. We'll talk about that later too. But the culmination of all this is now since 2012, we've raised and invested 5 funds. We're currently raising our 6th fund. And those 5 funds have all produced top quartile returns in the VC category as measured by Cambridge. So we're pretty confident that what we're doing works. So we claim to be different. What makes us different than other VCs? There are a lot of VCs out there. We think that we're different than any other VC that you have likely met. So a typical venture capital firm has a very tried and true model. There's a team of partners and associates and a big staff. And what they're setting out to do is build a concentrated portfolio of 15 to 25 companies on average. It might be invested vertically in a niche like healthcare. It might be focused entirely on software, hardware, but the goal is almost always trying to pick winners in a category. So let's just say that the niche or the vertical is healthcare SaaS. The VC fund is out to identify, if they think that that's a good area to invest, who's going to win that category. We think that that's very challenging. We'll talk about that later too, is picking the winner. But the result of this kind of dual goal of picking winners and concentrated portfolios is that it means that a typical VC almost never invests in a round size below $1 million. They start off investing $1 million, $2 million, $3 million early, and then they reserve capital for future funding rounds, and they expect over the years that they'll invest maybe another 10, 20, $30 million. So highly labor intensive, highly focused, and in our opinion, taking a lot of single company risk. This is where we're different. Our model is very different. We're building ultra diversified portfolios, and we mean 500 or 600 companies per fund. So we're not trying to identify, and I think Jeff and his co-founder Dave have used this expression a few times, at the stage we're investing very, very early, a venture capitalist is trying to separate the amazing from the ridiculous. That's what VCs on the left side do when they pick a winner. We think that's almost impossible. But what we think you can do is identify companies that have winning characteristics, a management team that's proved itself in the past, that's done it before, a product that the market wants, proof of revenue, proof of concept through revenue, existing customer bases, contracts for more business. There are lots of things that we've learned identify winners. And so our attempt is to identify companies that have winning characteristics. We might have 5 companies in that hypothetical healthcare SaaS vertical. We're not trying to pick the one. We're trying to pick the companies that we know from our research, and now having invested in over 1,800 companies with a lot of exits, we have great data and insight into what makes companies work. And the result of this is that we're investing in that very early in round sizes that are less than $1 million. That's very important to our investment thesis and our success. So what does a typical right side capital portfolio company look like when we invest? So you'll hear this from us often. Capital efficiency is extremely important to us. It might be one of the single biggest factors of success in venture. And what do we mean by capital efficiency? We mean the ability to get products to the market and scale them and build a business with modest needs for outside capital. This has worked well over the last 2 decades in our favor as the markets have become more capital efficient. So 20 years ago, around 2000, when the well-advertised tech bubble burst, it might have taken a company, a software company, $10 to $20 million to get a product into the marketplace. That same company today can get a product live in the hands of customers, generating revenue with well under $1 million. So that means that our companies are capital efficient. They have products in the hands of customers, and that's important to us. In our last fund and in this fund, all of our companies have revenue. They typically have monthly recurring revenue of, on average, $15,000 to $25,000. That's very important to us in our due diligence and our understanding of their model. We can see that the product sells. We can see who it sells to. We can examine the contracts. We can talk to customers, and we can get a good feeling for the future success. And then the other key characteristics, which we've mentioned, are the round size. So we're investing $100,000 to $500,000 at initial investment at valuations between $1.5 and $4 million. This is very important to the success of our strategy because it puts us in an area where there's virtually no institutional competition. Why is that? This is the opportunity that Jeff and his team sourced over a decade ago. And it's really a simple answer. The standard model for a venture capital firm is very labor intensive. Doing 6 or 9 months worth of due diligence and channel checks on a company before investing takes a lot of time and manpower. Taking a board seat takes a lot of time and manpower. Committing future rounds of capital takes time, manpower, and money. So as a result of this large commitment of time, talent, and money, the VC model really breaks down below sub $1 million. It's just not economically viable for them to invest below $1 million, and it completely breaks down below $500K. So this is the area that we've zoomed in on. So what's the result of that? If VCs can invest, who invests? Because clearly companies are still looking for capital. In fact, we would argue that more companies are looking for $500,000 of capital today than ever before because of what they can do with it. They can get to market. They can have build a business. So with more companies asking for capital and fewer VCs entering this space, you've got this big supply-demand imbalance. It's a market inefficiency that we love because it's where we operate. The competition for us when we look at companies and make investments are not professional or institutional venture capital funds. They're friends and family investors, angel investors, founders checkbook, founders credit card. And so that helps us, and Jeff will spend a lot more time talking about this. That allows us to enter at much better valuations. It allows us to negotiate great prices. And it really has added significant value to our investors. I'll stop there with the overview and turn it over to Jeff. And if there are any questions, maybe Arthur, it's a good time.
Yeah, maybe if it's okay, and you might be covering this, Jeff, so forgive me. Is it fair to say that because of the efficiency of technology and the minimum amount or the amount of capital that's needed to build a technology company has compressed considerably? Is it fair to say that and I happen to know what your process looks like, so it's a bit of a setup, but is it also allowed you to become super efficient in eliminating the people that just aren't going to qualify by your technology of onboarding potential customers, right? So is that efficiency inure to your benefit as well?
Yeah, it's a good point you bring up, Arthur. What we're talking about is this whole concept of capital efficiency in tech, which is just that this concept, which has been going on decades. It's not a new trend. It's just the idea that companies can build product, software we're talking about for the most part, with less capital more quickly every single year. And that's been going on for decades, and it leads to this new category that Curt's been talking about, what we call pre-VC stage investments, this new whole giant demand from companies looking for really small amounts of capital in this early phase of their life. Now, for the same reason our portfolio companies are able to create product more quickly, well, so can we. We have built systems and tools and a set of processes very efficiently too, to assist us at all steps of our investment process, from the first level filtering of the thousands of companies that come to us. We can do that today in an extremely efficient, cost-effective manner, in a way that, say, 15 years ago would have taken lots and lots of people. The technology was not advanced enough yet, or it would have taken a large amount of capital and a good amount of time for us to build those systems in a way that today, same thing for technical co-founders, it's off-the-shelf open source tools that are available to all of us today. So the short answer is yes, Arthur.
Yeah.
Absolutely.
Totally makes sense. And of course, like I said, I've seen the process, so I know how it eliminates the ones that are just simply not going to qualify. Right.
Yep. So let me move on from where Curt left off. So we've, as he described, we've identified a segment of the whole tech ecosystem that's evolved in more recent years, which is these small serial tranches of capital, needs from founders in the $100,000 to $500,000 range. And the most important concept to take away from that is that of what that has created as a disruption in the tech funding ecosystem, because that amount of capital is simply too small for the venture capital industry to address in their more labor-intensive model. Works great if you want to invest several $1,000,000 or more, and you have a concentrated portfolio and you're going to spend 3 to 6 months vetting companies. It doesn't work for companies that are only looking for $300,000, because that's all they need at that point in life. So we also know that, okay, the returns are much higher here, and the risks are higher. So we want to attack this end of the market. We want to take advantage of these inefficiencies. We want to take advantage of the lack of all competition from the venture community. But Curt laid out some of the challenges too. How are you going to do that? How are you going to create a portfolio with hundreds of companies? What we did is develop a data-driven investment process, like I mentioned. It's an investment process that will largely use the quantitative data that exists on a company, the objective data that exists on that company at that moment in time. We're talking about and all the other validation points they have at that moment in time to inform us of better profiles of companies to be investing into, and then we do them in large numbers. So the large numbers part of it, and we're building a very fast process and a very transparent funding process. We need to do that because we have to make fast decisions. And it just happens, though, that that product, if you will, that we're offering to the founding community, the startup community, being fast and transparent, we needed it because we had to make fast decisions so that we could build massively diversified portfolios, it's also exactly what founders want. If you're a founder of a startup and you've just gotten off the ground, you've got a product, you've got $10, $20, $30,000 of revenue, but there's all sorts of things you haven't figured out yet. Well, getting quick access to capital, even if it's at a little bit of lower valuation, is a lot more important than going through a arduous 3 to 6 month plus fundraising process to maybe raise a larger chunk of money at a little bit higher valuation. And
live another day, right?
What's that?
Live another day.
Yeah, so 6 months is a long time in the startup world, and anyway, so it really appeals towards exactly what founders are looking for, and effectively what we're doing is we're able to get a even lower valuation as a trade-off for that. And it's just like any market, if you're the only one offering something to people they can't get somewhere else, well, you can charge more for it, right? So it's essentially the same concept as getting a lower valuation. So the end result of all of that is it allows us to build these massively diversified portfolios, okay? Now, what does that result in, okay? And that's when you're now able to take hundreds of investments where you're investing in an extremely low valuation with very high expected return profile, and do this at a portfolio level. Now, you can, yes, certainly mitigate that downside risk, but you're also able to now, with much higher confidence, create a very high expected return profile. You know, our goal is to deliver a 3 to 5x net multiple to our investors over the life of our funds. That equates to roughly a 20%-ish IRR, give or take. We'll get to the tax stuff in a minute. It just happens that most of those gains happen to be free from federal taxes as well, and in most states. In addition to that, we'll get to that. What this chart is showing is our first 5 funds in a historical profile. So it's tracking quarterly TVPI, which is equivalent to NAV, the total return of each fund every quarter through their life. So if you're looking at it here, the blue line is our first fund. It's the longest. We're going to be winding it down later this year, actually. It's obviously had a phenomenal return. We've already distributed over 6x to our investors. There's about 1.5x still left in the fund. And you can see all the other funds as well. What's only other thing to really point out on this is the consistency of that return profile. What you don't see here is one fund doing extraordinarily well and the next fund doing really poorly and losing money or something like that, which is common in venture capital. That's expected when you have concentrated portfolios and you're taking more macro risk, vintage year risk. So we have this greater ability to produce a more repeatable and consistent return profile is the point.
So Jeff, could you mention, I think you're about to mention it, the size of the funds approximately, and is Fund 5 the one you're raising into, or 6?
Yeah, so we are raising Fund 6 right now. Funds Funds 4 and 5 were each about 35 million in size. They actually overlapped for a period of time. So we've been operating like a $70 million fund in the way we've been deploying capital for the past 2.5, 3 years. So to jump back into the performance, we just saw the chart before was showing the absolute performance over our first 5 funds. What this chart is showing is the relative performance versus the venture industry. The blue is the returns as of end of year in our first 4 funds. Fund 5 hasn't been around long enough to be meaningful here. So it's showing the total return of each fund as of the end of year 2023 relative to the Cambridge Associates US Venture Capital benchmark. So Cambridge Associates creates the most institutionally recognized benchmark for the venture industry. And this is showing the median. Okay, so fund 2, you can see our net multiple is 3.12. The median for venture index is 2.09. Okay, so not only are each of our funds handily beating the average of the venture industry, but all of our funds are actually in the top quartile, the top 25% of all venture funds that Cambridge tracks.
And to be fair, does this account for the tax advantage, or is it
No, this is just pure pre-tax gains and total return. And TVPI is a measurement of total value, so it includes distributed capital plus the remaining value in the fund, and it's not accounting for any taxes involved.
Got it.
So let's talk about the exit side of things. People often ask, you're investing really early. Where do you get your exits? So this table is showing our top 10 exits as of the end of last year, which came out of our first 3 funds, as you'd expect. And there's a couple things to note here. First is that we are regularly getting 50 to 100, 300x plus multiples on our exits that are most meaningful to us. And the average very successful exit in early to late stage ventures, $10 to $50,000, 10 to 50x multiples would be phenomenal, because they're entering into companies at a 10, 50, $300 million valuations. And so they need extremely large exits to produce these multiples. And it's extremely rare. You need an Uber, Facebook, Google kind of stuff to get to those, 500 to 1000x multiples. We don't. We are exiting essentially when late stage venture growth equity are entering positions. All of these exits you see here are on companies that were either acquired or were selling in the secondary market. And in one case, there was an IPO. But we're largely selling at a $500 million to $6 billion valuation. That's where all these exits occurred. And again, that's most of the capital has come from us selling to late stage venture and growth equity in the secondary market. And that allows us to proactively sell when we want to, as opposed to having to wait for a big event like an IPO or an acquisition, which may never happen on a company. Another side point, not to get off topic, but this secondary market is something that has ballooned in size and demand over the past decade as well. When we began building our strategy in 2010, this just wasn't part of the exit scenario as much. So that's been a huge boon for investors like us, any early stage venture, angel investors, angel groups. It's been a phenomenal addition to the entire liquidity profile of where everybody can now get liquidity.
And was that driven partially by companies deciding to stay private longer as well?
Yeah, that's definitely part of it. It's because companies can successfully raise the capital they need well into the many, many billions of dollars in market size in a way that, in the 90s, early 2000s, you couldn't. You needed to go public if you wanted to get that kind of capital. So yes, they were successfully raising capital for longer. And it just, it evolved to creating, especially from late stage venture and growth equity, more and more demand from them to buy companies. And they're essentially going to early venture funds like us to get the companies they want, because sometimes they don't want to wait around for a company to raise a primary round. It doesn't matter to them. They just want that company. So yeah, that's part of the reason, Arthur.
Yeah, we haven't talked about this, but in part of your leverage of going early and dictating terms more or less, are you able to address the dilution or follow on and all that business?
That's a much bigger topic, so I won't
Fair
go
enough.
into all the details there. But the short answer is no, and that's purposeful. So there's two things you brought up there. One, we're effectively, when we invest, we're typically the first real outside investor. You actually don't want to put onerous terms in when we invest. That creates problems for the next rounds after us.
Yeah.
And it becomes a hurdle that those companies need to overcome. Because if we have 2x, 3x preferences and all sorts of onerous terms,
makes it harder for them to raise
crazy early stage.
Yeah.
Well, that makes it harder for that company to raise their seed round, because the new investors coming in go, well, gee, what do you mean these guys have a 3x preference or something? We don't want to touch that company.
Yeah.
So it's just too early for those kind of things. That happens late stage venture much more without problems. And secondly, the whole idea of, you brought up the idea of follow on subsequent rounds of capital. So that's I won't go into the details there, but the short answer is no. We do not do any follow-on investing into companies. It's problematical for a lot of reasons, but ultimately the big reason why we don't is it is ultimately dilutive to the fund level performance as a whole. Because clearly, yes, there are companies that we see in our portfolio early on that are having great success that would warrant an additional investment that would have a high expected return. But when you have a portfolio of hundreds of companies, you create more damage to those companies that you're not investing another check into, and that overcomes the advantage you get out of those few that you choose you are investing. It's called signaling, a negative signal created. Because if you're not investing in a company, you're known as a subsequent round investor, it's a red flag up the flagpole to any future investors.
Yep, the optics. Fair enough. Makes sense.
Exactly. So let's move to the tax side. Okay, so we've referenced this a couple times. It turns out that there's a couple really impactful IRS tax rules that have been around for a long time, actually, but they were simplified in 2010, and that are designed to incent early investors like us, like angel investors and founders. And ultimately, it was originally the rules were created originally to for job creation and as an incentive for the investors, because it's high risk stuff when you're looking at investing in any individual company. So the first is what's referred to as QSBS, Qualified Small Business Stock Rule. This is IRS Rule 1202. And again, I'm only going to touch on the high level of these rules. It's very nuanced. The most important thing I can leave people with is, if you are an early investor, if you're an angel investor or you invest in funds like us, make sure your CPA is aware of these rules and you're tracking this stuff. So what is QSBS? It's a rule that allows for, if it's a qualified small business stock gain, if it's qualified, those gains can be free from federal taxes. And it turns out that 45 of our 50 states conform to that same rule. Now, the most important parts of the rule is that you have to be invested very early in the life of the company. It's only applicable for U.S. companies and U.S. C corporations, and you have to have held your shares of that company for a minimum of 5 years as equity before the potential liquidity event. So again, it's only really applicable for very early investors. Now, it just happens that everything I've just described there, it looks like we created a strategy to take advantage of these rules. It's just all coincidental. Everything we do tends to fit for all of this. Most of our big gains are companies that have taken 5 years or more to get to that state. And what the rule says is that if it is a qualifying event, you can get up to the greater of $10 million or 10x your capital basis, whichever is greater, free from federal taxes. So when you're in a fund, that flows through on the K1. So actually, the IRS treats every limited partner of a fund, you get up, that limited partner of the fund gets up to $10 million of gains on every single portfolio company that could have an event. So for early investors like us that are putting small dollar amounts into each company, getting $10 million of gains per company, you're never going to hit that at an individual, LP level. So it's a huge potential tax break for all of our stuff. The second rule, which deals with how losses are treated, not quite as exciting as gains, but it's still impactful. It's called IRS Rule 1244, and it's a rule that's even more challenging. You have to be part of the first, $1 million raised in a company, and for QSBS companies that you've entered into that early, if it fails, and remember, most of the startups fail, you can actually qualify it as a 1244 loss. In a 1244 loss, unlike just a capital loss, you can use against ordinary income. So you can use it to greater effect. And remember, the early years, we invest capital over usually 3 to 4 years in our funds. Years 3, 4, 5, 6 in the fund, we have lots of companies fail, and we take those losses and we push them through. So you're taking early losses that are pushed through on the K1, a lot of which, actually the majority we expect of those losses to be 1244 losses. So you actually can reap the benefits of the losses in the early days, and then later on in the life cycle of the fund, you're reaping the rewards of QSBS tax-free gains on what we think is going to be the majority of the gains as well.
How many companies do you expect to invest in Fund 6?
So we expect Fund 6 to have at least 600 portfolio companies in it. It could have as high as 700 to 800, depending on how big our fund gets.
Is it okay? Can we talk about what you do with companies post-investment, like how involved you are?
Yeah, sure. Let me finish one point on the tax stuff first, and then I'll answer that question. Don't let me forget. So I wanted to just describe the net effect of all this tax stuff I just described, what's been the actual experience for our investors, not just the theory of what could happen on because of these tax rules. So what this is showing is purely the summary information for a $1 million investor in our first fund. So this was a fund that was launched in 2012, and this is the data taken from the K1s over 11 years. And what it shows you here is we have now Fund 1, by the way, for a $1 million investor, we actually didn't have to call all the capital. They paid in $930,000 of their $1 million commitment, because actually in year 3, we had an exit that offset some of it. So they invested $930,000, and we've distributed back to that investor $5.7 million. That's a 11-year period. They had zero, actually less than zero, federal taxes paid. Now, that doesn't mean that in a couple years here and there were some long-term capital gains. So this is the aggregate. This is showing the aggregate, because more than 90% of all of the gains, that $5.7 million, were QSBS qualified gains. But we still have all the losses to push through too. And the losses we pushed through more than made up for the remaining taxable gains that were there. So actually, there were we actually underestimated when we first started how impactful all of this would be. Okay, so Arthur, your question. Remind me again what your question was.
Yeah, you count on me to remember.
Were you asking about how we?
Oh no, what you do post investment?
Yeah,
how involved you are with the companies.
Yeah. So good point. So you asked about how many companies are going to be in the fund. So yeah, an obvious question is how do you, are you just a passive investor? Do you help companies? How could you help so many companies on any kind of systematic basis? So the short answer is yes, we do add value. We do help companies. Think of us like heavy mentors with companies at very specific and targeted areas of their business. So what we're not doing is taking board seats like a traditional venture fund. We're not, having laborious, multi-hour conversations, board meetings every 6 weeks or whatever. We're not talking about their product roadmaps, their hiring roadmaps, all that kind of stuff. What we are doing is targeting what we believe are some of the most impactful areas of their business, such as helping the companies with their subsequent funding rounds. Most of these companies are going to need more money after us. If we're not writing the check, and we're not, we help them get those rounds done. Secondly, it's helping the companies with their sales and go-to-market strategy. We have a dedicated person who's referred to as the sales doctor by our companies. He can jump in, diagnose a situation with a company, help provide some advice to that company, and monitor afterwards. And what I just described are two areas we have dedicated people to. What's important here is the idea is we can do this scalably to large numbers of companies, and we can add that kind of value. Those are just two examples. There's other areas as well, but the idea is we can then jump in at periods of time in that company's life where they're having an issue, they need to raise capital, or they're hiring their first VP of sales, or whatever it might be. We can help them with it, provide expertise, and then we can step away. We're not helping all 600 companies every week or something like that. There's only, either of these people might be helping 30 to 50 companies at any given period of time over the cycle. So it allows us to really add value in a scalable way.
Totally makes sense. All right.
So putting all of this together now, sort of to, bring it back up to the high level, for investors at this end of the market, what we call pre-VC stage, to summarize sort of what we're able to deliver to our investors in our funds is, as a reminder, we can now provide a much more, stable, predictable return profile that's still a very high return. We can help mitigate the downside through this massive diversification, create a high confidence of creating that high upside, and then have this massive tax efficiency on top of it all. So now we're going to move toward any further Q&A, Arthur.
Yeah, so there's a couple things. What do you think about the sentiment and the environment and the narrative that's going on presently over the last couple of years as it relates to a good entry point for venture investing?
Right. Good question. So you're correct. The past 2 years have been very challenging for the venture industry at all stages, and for tech startups, especially. So tech industry, even though our economy is not in a recession, I guess some people might argue that, but effectively it's not really in a recession, and markets at all-time highs. The tech industry has been having actually a bit of a recession, because you've probably seen all the news over the past couple of years of all the big tech is laying off workers and stuff. So that has all trickled down, and with interest rates going up over the past couple of years, that has led to tech companies retrenching, cutting costs, and it's led to what's easily the most challenging fundraising environment for the startup world, again, at all stages, easily in the past 15 years since the financial crisis, and probably going back a good bit further before that. So the numbers of funding rounds have plummeted. The amount of capital going into the industry has plummeted. And it's been 2 years of that. So it's been a brutal market in the past 2 years. Now, that's led to challenges for liquidity. It's led to challenges for late stage venture, especially. Multiples have come down. But they remember, for new investing activity, it couldn't be better, right? All of those reasons lead to why it's actually some of the best years, last year, this year, next year, for new investors. Anybody investing new capital, like any industry, you're going to, that's has less demand, less capital going into it. We're going to get lower prices. So that certainly happens. In addition, you have, remember that venture capital thrives off of disruption. Venture capital at all stages is about, it's a small percentage of companies represent the bulk of where all the liquidity comes from. And in a disrupted environment like we have today in the tech industry, or disruption like happened with COVID in 2020, or disruption in a financial crisis, yes, that creates all sorts of problems. It creates larger failures in certain industries, but it also creates opportunity. And new opportunities, the multiples on the upside are so high that it disproportionately affects the performance at the asset class level. So you have an environment today that this disruption is actually a positive for venture capital, because it creates opportunity, it shakes things up. It also allows startups to attack competitors more easily, right? If you're the big tech is laying off workers, big tech is struggling to figure out how to approach AI and what policies they need to have within their big corporations and what their employees are going to use. Startups don't have any of those issues.
Right.
AI is this phenomenal tool that anybody can use right now, and they're using it. And AI is this giant tailwind that's allowing scrappy founders, and by definition, good founders are scrappy, to do more with even less capital. Whereas big tech is going to be slow to figure it all out because of policy constraints. So anyway, those are a bunch of reasons why now is actually, in these recent years, are great to be deploying new capital into the market.
And AI arguably could even put another X factor on the efficiency, right?
Exactly. So there's obviously there's pure AI play companies like OpenAI and stuff, but AI is like, we're going to be talking about AI a few years from now, like we talk about the internet, right?
Yeah.
In the back in dot-com bubble days, the internet, are you an internet company, right? Well, internet led to just efficiencies at all level for all companies, to sell goods, to communicate, etc. AI is like that. We look at it like it's this enabling technology and a tailwind for the industry as a whole, to allow for greater efficiencies, to cut costs, right? I mean, you hear the fears out there of it's going to lead to laying off workers in a lot of areas. That's true. It's also going to lead to great opportunity.
Yeah, I think so. We covered this a little bit, but let's clear up. We have a question about, if you have a liquidity event in year 3 or 5, you distribute to the partners or reinvest in the fund. I think you pay back the principal and then some, right?
Yeah. So in general, we do not recycle capital. So if there's a impactful exit, we distribute that to our LPs. Now, the only exception is during the investment period, the first 3 years, if there are small liquidity events, and occasionally there's some, a failed company sells itself for $1 million or something, or $2 million. Well, that's a liquidity event for us, but we're not going to make these small distributions. That will be left in the fund. But any large distribution, we're distributing it. We're not recycling capital.
Can we talk a little bit about input, meaning do you source companies by uploading TechCrunch or PitchBook, or is it organic? Do you have a team of people that are looking for new companies? How's that? And how do you manage so many, right?
Yeah, so it's all about building systems. No different than a hospital that might have, I don't know how many patients go through a hospital in a given year, a million, more, I don't know. But how does a hospital handle that? Well, they have a database. They have, the doctors have charts, right? So it's all of the data on all of those patients are kept in a database that any worker in that hospital can pull up the chart on that person and be informed immediately. It's the same with us. Instead of a patient, it's a company. And so we have a database, if you will, that we have built and customized and continually add into that allows us to manage all of our portfolio companies. So when you ask how do we manage them, we have a team of data analysts, 3 now, that operate under one of my partners, Kevin, that their primary job, what takes up most of their days, is capturing all of the company updates, KPIs, and other business updates from companies on a regular formatted monthly or quarterly level from all of our companies. And that data gets into our database. There is an unavoidable allotment of manpower that goes into that. But it ultimately gets into a database. On the front end, when you talk about deal flow, it's the same concept. We have built systems at the front end. Think of us as we have this gargantuan front end of the funnel with many thousands of companies coming to us. We're not going out to scrape information on LinkedIn or Crunchbase or something because these companies haven't raised any prior venture rounds yet. There is no data out there accessible publicly to capture that information. So we don't do it that way. You can't. So we're attracting companies to us through all sorts of deal flow channels, huge number of relationships in the accelerator community and other areas, so that deal flow comes to us, and we have built systems that allow us to extremely rapidly cut through 95% of the noise virtually without putting any kind of time into those companies.
Yeah, sounds like it's...
So that when we get to the unavoidable, when we get to the part where we want to diligence a company, we only want to do that on companies we know fit for our of what we want to do, and that we're prepared to write a check to. So we want to cut through it all as fast as possible.
Yeah, totally makes sense. How much of when you've are there companies that you want to invest in and they're not a C Corp? Do they switch? Like, is that a big barrier?
Yeah. So we don't, there's a number of problems with it. It's not just for the tax purposes, but if you're a venture fund, and not just us, it's an industry-wide thing. You don't want to invest in a pass-through entity like a S Corp or an LLC, because if a venture firm like us, if they have some of our investors or pensions or something, it actually busts some of the rules that they have to abide by. Because of pass-through income, UBTI, and stuff like that. So yes, we're only investing in C corporations, and if they're not a C corporation, they've largely gotten bad advice from a lawyer, and we tell them that they need, or they can only be raised money from individuals, and they need to transfer the structure of the company, which is not that big of a deal, really.
Yeah, it's not that big of a deal. Do they make it through your SIV as a pass-through entity, or is that automatically?
It would automatically discount it. That said, if it's something that otherwise would fit our criteria, we would communicate this to them and let them know that they should come back to us when they're a C corporation. Or sometimes companies are aware of this and they're sort of in the process already, so it's not that big of a deal. It's not. Most companies are already C corporations. Remember, if they've, these are today, this isn't about companies where there are a group of founders come together with an idea and they don't really have anything else yet. Today, we're largely investing in companies that already have bootstrapped themselves to building a product. They've got some customers, they have revenue. So there's a corporation there already.
Yep, totally makes sense. What do you look for in an LP in your fund? Somebody's going to write a 250,000 check, $1 million check, $5 million check. What's the good profile?
Well, in what you just described there, to be a little flippant at first, more is always better.
Yes,
But
it totally makes sense.
but the bulk of our investors fall into a couple of categories because of the huge tax benefits. The bulk are family offices, very high net worth individuals, and a lot of our capital is directed to us by wealth management firms that utilize our funds for their clients, which again are the same type of things, individuals and family offices. Usually it's by dollars, usually it's $500,000 commitments to 5 million. But yes, we are flexible down to $250,000 commitments. And these are structured as capital call structures. For people not familiar with that, it means if you want to invest $1 million, you don't send the money to the fund like us day one. That's called over our investment period, which is roughly 3 years. So if somebody coming into our fund today, they would need to send us 30% of that $1 million commitment, and the balance would be sent to us as we call it in. We call it in as needed every 6 months for the balance of that capital.
Yeah, so like a private equity drawdown
Yep,
situation.
exactly.
Yeah. What do you anticipate the size of Fund 6 being?
Yeah, so we're targeting 100 million, and could be anywhere from 70 to 130, something like that. It's still early in the process, so we'll see where it lands. We have over 35 million committed in the fund already. We will be fundraising through at least the end of the year.
Yeah, we've talked about this before, and in this, Curt, you said it earlier, we're not giving tax advice, but what's the sentiment in DC about the continuation of these tax rules?
Well, what I can say is currently we're not aware of any proposed bills or amendments that would affect it today. There have occasionally been times where it comes up. A few years ago in the there was the, what was it called, Build Back Better thing. A few years ago,
yeah,
they had proposed rolling back some of the QSBS, so the end result would be it would only be half as good. They're not. It ended up, that ended up dying. It didn't go anywhere. These rules can change, as we know. Tax rules can be amended and changed. Yeah. There's nothing currently that we're aware of where that's being proposed, but who knows down the line.
Yeah. So we have a observation and question here from the group. Oftentimes VCs are doing a lot of heavy lifting, a lot of due diligence, and incur a fair amount of legal bills. Have you boilerplated the process such that you can avoid a lot of the legal fees associated with taking on a company?
Yeah, 100%. We don't employ any legal in our front end execution of investing in a new company. So it's not necessary because they, at the time we invest, these companies have not had prior rounds. We don't have to pour through documents. We don't need to go through historical legal stuff. And the investment documents we use are basically standard industry stuff now, referred to as SAFEs, simple agreement for equity is what they're referred to. It used to be convertible notes, but yeah, these are standardized things now. We have our own that are standardized, but that concept is actually industry standard now as well. So for investors like us, we're not unique in this particular regard. Most firms don't need to really employ legal until it extensively anyway, until it gets later on in the cycle of a company.
Have you found what Curt said earlier, the traditional competitor to your check has been friends and family, founder, that angel type folks? Have you found that you're competing against that or just augmenting that?
Augmenting would be a way I would describe it. We're because the amount of capital sought by these companies or needed by these companies is largely too small for the venture industry. It's hard for a lot of people to get their head around this. There's just no competition. We do not have competing term sheets, right? We don't lose deals because a company chooses a different venture firm or something like that. Just like literally never happens, which is hard to understand because at a Series A stage, it is extremely competitive, and good companies are choosing which venture firm they want to take capital from. It is very competitive. They have multiple term sheets if they're a good company. That just does not exist at our stage. So yes, the other capital around us is friends and family, capital from the founders themselves, and individual angel investors. Occasionally, in a small percentage of our companies, it's sort of the semi-professional, it might be a founder that had an exit. They've got $30 million. They do lots of tech investing now. They're a solo practitioner fund or something like that. So occasionally there's stuff like that as well. There's just not enough of it there to what you call being competitive, because they're not offering term sheets most of the time. When I say there's capital around us, it can be, if they have angels or friends and family, it's usually those friends and family and angels are saying, hey, we're really interested in your company. Let us know when you get a lead. Like, they don't know how to price it. They don't know what to do. And they're waiting for something to happen, because most investors are not really in any rush to invest money. They always want to see more progress on a company first.
Right. Exactly.
So all of a sudden we come along, we plant a flag and say, we're doing a round, and here's the price, and here's how much we're putting in. And that allows the founders to go out and say to all their people that are dancing around them, say, here it is. If you want on at a $2.5 million valuation, now's your time. And that's it.
Yeah, it's a huge. Isn't it really interesting that the general consensus is it costs as much to write a $500,000 check as a $25 million one? And in your case, it's not true, right?
Correct. Yeah. I mean, legitimately, if it's a Series B $25 million round, and there's been 3 prior rounds, there is more work there that needs to be. I mean, there's more stuff that needs to be looked at. There's more diligence needs to be done. There's legal diligence. There is. I mean, it just exists there. But yeah, it doesn't exist at our stage.
So having done this in this segment for so long, pre-VC, have you seen other people jump on board with competitive funds? You don't have to say who they are. I'm just wondering whether
no,
you've caused other boats to rise, right?
Yeah. So for the most part, no. What we have seen, going back to when we started in 2010, 2012, when we launched the fund, the market's changed entirely. When we started, the term micro VC didn't exist. The term pre-seed venture didn't exist, right? All of these, seed stage didn't exist 15 years ago, right? These terms came to being because of the same trend we keep talking about, this capital efficiency trend within tech. The capital needs kept coming down, and 15 years ago, it gave birth to seed stage, and then it gave birth to pre-seed stage. It gave birth to the accelerators to do what they can do. We're an extension of that. And so yes, when we first started going out, no one was really addressing this end of the market at all, right? They're doing funds with hundreds of companies was a crazy concept to most people we talked to. There are firms doing pieces of what we do today. Yes, you're absolutely right. There are firms that have larger numbers of investments in them. It's not a revolutionary concept to understand that when you go into an end of the market with individual companies that have higher risk but higher potential return, you want to do more companies. You want to have more shots on goal, so to speak, the earlier you go. it just what hadn't really been done. Now there are firms doing that concept. There are firms, there are firms that'll write $250,000 checks. It's just usually they're writing checks into $1 million or $2 million rounds. So there are firms taking some pieces of what we do. We're not aware of really anyone putting it all together and having, a single fund where all of the capital is invested at this stage in an ultra diversified way. We're just not really aware of any out there like that.
Yeah, so we've gone over time, but it's totally cool. I have one last question from the group.
Yep.
If you have winding up the fund, for example, and there's private shares that are illiquid and you largely can sell them on the secondary marketplace, do you just extend the life of the fund?
So we could, and so for our first fund, we'll use that as an example. We're now at, almost at year 12, and we did extend it by 2 years. But ultimately, it's a good question, because the reality is, yes, many of these companies, we still have lots of companies in the fund. Some of them are doing extremely well. So we will still wind the fund down and provide liquidity for all of our investors. And we don't do that by just distributing a bunch of private shares to all of our investors. None of our investors want that. Okay. We still have, 75 companies that are operational, active companies in our fund one. And, but the bulk of the remaining value in that fund resides in, a dozen companies. So what we'll do is there's a couple different ways it can work, but one of the most common ways is what's called a continuation fund. Essentially, an institution comes along and offers to buy out all of our existing LPs, giving them liquidity. They come into this seasoned later stage portfolio of stuff, and so it's restructured and the fund continues, but the fund continues with a new investor on board. All of our existing investors have the option to cash out.
That sounds like a good business.
It is. It's part of this whole, again, the secondary market that we keep talking about. Instead of us selling our companies directly as a direct secondary, there's a whole fund secondary business that's evolved as well.
Yeah, very cool.
The short of it is, it's a great thing because it, again, allows more liquidity options for people like us.
Meanwhile, is the example of fund one, at using that example, is the investors are not got their knickers in the twist about it continuing, because they've got their money back plus a considerable amount of upside with virtually no tax. I'm saying that, you don't have to say that. So there's probably no complaints about that, right?
Correct. Yeah. I mean, obviously our first fund's done extraordinarily well, and all of our investors are extremely happy. If we told them we were continuing the fund, none of them would care. Yeah. But we've always messaged to our LPs that we want to provide liquidity to them. It's not an evergreen fund. It doesn't just go forever, and we're not intending it to just keep going forever. We'll give them the option for liquidity.
Yeah. Super cool. Well, this has been super helpful once again. Jeff, really appreciate you being here, and Curt,
yeah, thank you
for joining, and thank you all for sharing some of your time with us today. And we'll make sure everybody gets in touch with Jeff and Curt. And you guys want to close a closing comment?
Yeah, well, thank you, Arthur, for setting this whole thing up. Thank you, everybody, for having joined us today. Anybody that is interested to receive information about our funds, our history, the tax stuff, you want to chat about what we do, feel free to, contact information's in front of you. Feel free to reach out to either of us.
Yeah, super appreciate you being here. Really good to see you. And Curt, nice meeting you. And thank you all for sharing with us the only thing you can't make more of, and that's your time. Till next time. Thank you. Take care.
Thank you very much. Bye-bye.